Hello everyone and welcome to African Giant Crypto Signal class. Today I want us to go through all of the terminologies that are involved in cryptocurrency. Let me tell you, if I have to teach you everything here, then you need to know all the likely terminologies that we're going to use, because once I start using those terminologies, you have to be familiar with it. So between now and about 2 or 3 days, if possible, you can note them down and get yourself conversant with it, so that once I use these languages, then it won't look like a mountain. It will be easier for you to know. Let's go straight into it, because we have about 31 of such. Now I said 31, I'm sure some of it you would know already. I will try my best to explain to the BRS minimum so that you will understand everything. I told you this is a beginner's class, and even if you are in GSS2, you will understand everything by the examples and everything that I'm going to use. All right, let's get started. The first one is blockchain. Block and chain. This is a decentralized distributed ledger that records all transactions across multiple computers or nodes. Now, you don't have to stress yourself much about this blockchain, because how it works is just like this. You see this pictorial diagram? These are computers. This is a computer, this is a phone, a computer, a phone. You see, all of them are connected to each other, and that's why it's a decentralized. The meaning of decentralized is not controlled by government. You know, for example, now you can't just print 50 naira in your house. You can't transfer 50 naira to anybody online. You can't do any of those unless it is controlled by the government. The way the government controls that is through the bank. So you have to use UBA, GTB, Wema Bank, Fidelity Bank, Zenith Bank, any of these to transfer money, and they know how much is being transferred. But once it gets to blockchain, the blockchain is a decentralized distributed ledger. It's just like the bank, but nobody's controlling it. It records all the transactions across multiple computers at the same time, and it processes it, and is not stored in one place. There is no singular database for these transactions. Is set on the blockchain, and it's all over just like that. So if I make a product here on any crypto, if I send $1 on my crypto to you, it's processed across all of these laptops that are connected together. Once you sign into an account, you are also connected to that. It's like a giant web of all accounts, but then the processing is spiral through all accounts to process one, and so nobody's controlling it. That's the whole essence of blockchain. I hope that is clear. Okay, the second one is cryptocurrency itself. Digital currency. You know, physical money, physical currency. Digital, it's money online. The funniest thing is, even the banks have digital currencies now, but they might not call it crypto, because they want you transfer. If you have 5,000 naira in your UBA, if you check your app, you see 5,000 naira. You know, that's not in cash. It's digital money. Any currency online that stands for money is digital currency. So the real meaning of cryptocurrency is a digital currency that uses cryptography for security and operates independently of the central bank on the blockchain. The only difference is the digital currency of the bank is fiat money, F-I-A-T. They call it fiat money. And even if you can transfer it as digital currency, it's domiciled on central bank of every country, central bank of each country, and they are the ones that process it. So they control that. But once it comes to cryptocurrency, it's a form of digital currency that domiciles on blockchain. Remember, I told you blockchain, connecting all computers and processing everything together at the same time. Nobody controls it. So that is cryptocurrency. That's why if you want to steal something, like in those days, I thought cryptocurrency is just for scammers. Like maybe you want to take one wrong money somewhere, you don't want anybody to know. You know, that was what I felt it was for. But now, you know, in the early stages, you have this sentiment. I remember the first time they brought ATM to Nigeria. I didn't use ATM for like 3 years, because I'm like, I'll put one card inside this and it will access my account. What if I go and somebody else just remove my money, you know? Because at that beginning, it will take you time to adjust to the new technologies and all. But now it's fully adjusted. Nobody even worries about using an ATM again, even old women and old men, because everybody had tuned in. The same thing, cryptocurrency is now digital currency that is domiciled on a blockchain, meaning connected to everybody are not connected to one single person. And this is an example of them. We have Pepe, we have Binance, we have Bitcoin, we have Ethereum, we have Pi, we have Solana. All of these are all cryptocurrencies, and companies are creating them. You can create one. I created one, Cola. I hosted mine on Bloom, and then Bloom also hosted on a blockchain. It's a technology, so you can host on them just like a browser. Remember in around 1990 something, 95, then there was the influx of the www. You see, every website looks normal now. In the early stages, it was not normal. We have about 10 websites in the whole world at that time, and only the likes of Alibaba, Amazon had access to websites then, and they were always putting things on it just like we do now. But only me has 24 websites now, so you can imagine how things have become so common. You see, all this cryptocurrency, they are still going to be very common. That even our children, they will just have their own wallets and all of these. But now it's still looking like a big deal, because we are seeing the early stages of this. With time, individuals will be able to build their own blockchain and create their own bank and put it on it. Technology will get to that level. But for now, unless you are a programmer, that's the only time you can build a currency or a coin on the blockchain, which is connected to everybody. Somebody started it too, because that's the whole thing. Somebody started it, but he started it and did not have control over it. He created that thing and did not put any loophole of this is how we control it, and just allowed it to roll on his own. So the owner cannot even say anything. Satoshi, they usually rumor is the owner, doesn't even have a control over it again. But of course, the patent is out. Anybody who can program can create their own blockchain and put it on it, and all these other juicy things. So that is cryptocurrency. I hope it's clear. Okay, and I hope I'm not too fast. Now we have altcoin. We are talking about cryptocurrency. There is Bitcoin, which is the start of all of these industry, and then we now have altcoin. Any other currency other than BTC, which is Bitcoin, including Ethereum, Ripple, Litecoin, anyone, they are all called altcoin, alternative coin, altcoin. So it's Bitcoin and others. That's practically what it is. And this is why it's funny when you have some people say, oh, this our new coin will surpass Bitcoin. There is no other one that can even come remotely close to it. For example, if you look at the price today, you see Bitcoin is about $84,000 per one Bitcoin, technically. And then the other ones are what? Ethereum is the closest. It's about $2,300. You can see the wide difference. So it's like Bitcoin is the alpha and omega of everything. Then all other coins are categorized as altcoin. So you see all of these other type of coin, Pi, Theta, whatever it is, and all the meme coins, all the Amstar coin, X coin, they are all alternative coins. Very well. Now we have exchange. A platform where crypto can be bought, sold, or traded are called exchanges. So you see, crypto coin is like an industry. Somebody has that. Okay. All other coins that are created are altcoins. You are getting it? The blockchain is where a crypto is domiciled. That's the one that transacts and makes all of these selling, buying, all of this possible, is where the ledger is kept. So now, if you have a coin and you want to sell it, and there is no bank to keep the record for you, the blockchain is like your bank, but it's decentralized. Nobody controls it. So it's not like somebody will go there and tamper with anything or change anything. So you see why it's very unique. But now, exchanges now are the platforms that allow you to buy and sell it. So the exchanges are built on the blockchain, and then the coins are the ones that we trade. You understand it now? So that is the base of every cryptocurrency. So your exchanges, for example, you have Binance. For example, let me see. Binance, you have BitGet, you have OKS, you have Gate.io, CEX. There are lots of them sprouting up now. It's technology. Once you can build your own and you can pass the KYC and pass everything they're asking, off you go. So basically, those exchanges are where we trade. So for the purpose of this class, once we get to trading, you now be using those exchanges to trade, especially the ones that we can use in Nigeria. The basic one that allows us to do P2P, like peer-to-peer, where I can have and sell to you, even in Nigeria, is Bybit. So majorly, whatever we do, we're going to do it more on Bybit and also Binance and also BitGet. So depending on which one, but you can transfer your funds across each other, the same process. So that is exchanges. Now these are exchanges. Those exchanges, they are not the coins. It's just a house. It's just like GTB is not money. but it's just the house where we go and change money. So the exchanges are the platforms that allow us to exchange, trade, and do everything, but they are not the real coin. Coins, all of these coins you see, Ethereum and all, is owned by separate individuals. I'm explaining it better. Separate individuals. Exchanges, the person that has the exchange is also different from the person that has the coin. So you bring your coin to us, we approve it for trading on our platform as Binance. You can see Pi now. If you are interested in Pi or you have been following Pi, you see that Pi Network is trying to build their own exchange because Binance is not listing, Bybit is not listing them, and so they are like, okay, we're gonna build our own and then we approve it. So you won't use us to do shakara again, because the Binance doesn't have his own coin. It's just there to let other coin owners trade on it. You see that. So that's another terminologies. Okay, we have volatility. If you hear the word volatility in crypto, is the rapid and significant price fluctuations that are common in crypto markets. If you see crypto chart, something like this, you just see to go to up and down, up and down, up and down, up and down, like that. That's volatility. Crypto market is so volatile, very volatile. I can't really, apart from forex market, also volatile. Crypto is very volatile, because from the beginning you can see something on $1 now, in the next 15 minutes it's on $4. Meaning if you put 100 naira, meaning if you put $100 in it, in 5 minutes you're already on what? $400, just like that, if you guess it correctly, if you know it's going up. So it's very volatile, and this is the interpretation of it that I put here, where things are going up, down, up, down, up, down. That is what it meant by volatility. Now we have liquidity. If you are hearing about liquidity in crypto terms, the ease with which an asset can be bought or sold without causing significant price changes, where a deep market with plenty of liquidity indicates a healthy market. The ease at which an asset, which is a coin, can be bought or sold without causing significant price changes. Let me give you an example. If you walk into, let's say, Mercedes-Benz right now, and you buy a Benz brand new, and then you drive it back home, and then you come back, will you sell it the same price? That's why we say they are not liquid. But if you walk into my Tama today, and then you buy a brand new land, and you walk home, and you come back tomorrow, will it still maintain its value? Absolutely, or even maintain more. Liquidity, the ease with which assets can be bought and sold without causing significant price changes. And this is the pictorial diagram of that. You see there's a digital tokens. You can convert it to cash. I told you on buying bits, I'll show all of that to us as we proceed, where you can convert your cash to tokens, which is your coin. You can also convert it back and it won't lose value. If a token is $1, if your $1 outside wants to convert to USDT, it's still one USDT, and then you can change it back to dollar, you can change it back to the USDT, it still maintains the same thing. And even if you convert it back to another token, the equivalent conversion to other tokens is what it takes. So if it is 1 USDT is 0.9 Ethereum, once you change it, it's still the 0.9 Ethereum. You understand it? If it is 5 ton, then it is 5 ton. Not like it's going to change. So that is the liquidity of a cryptocurrency. You can change from currency to currency without having problem. And if you change to Pi, for example, and then you change from Pi back to USDT, it will still maintain the same amount without really significantly changing. Although, you know, market prices, if the prices are going down, but it's very little, not like plenty. That's liquidity in cryptocurrency. Next is what we call the liquidity pool. Now, some of this language, like this liquidity pool, I don't think I'm going to be using it much, because it's just the supply of funds locked in a smart contracts that are provided by traders to facilitate trading in decentralized exchanges. Some of these words are there. I just want us to know, like I told you, you want to be a guru. There's a difference between trading, and knowing. The way I section this class, I hope that those of us that are students here, we appreciate it. I want us to learn as much as we are making money. That's why during the week is signal days, where if I see valuable things we can buy, I tell us. If there is none, I don't tell. It's not like compulsory, I must give it. But once we get to weekend, we learn. So we learn more so that you can know more, so that by the end of the 2 months, you are fantastic. I'm not saying the signals will end by 2 months, but at least we use 2 months for the classes so that everybody can be good. And then from there, you are good on your own. If you like, you pick my signals. If you like, you do your own. But I will taught you enough to be able to do it on your own. But liquidity pool is just a supply of funds locked in a smart contract that provide traders to facilitate tradings in decentralized exchanges. These pools enable users to trade crypto without relying on any traditional order books. So this is the process. Liquidity provider, you pay a trading fee, you go to liquidity pool, you go pay a trading fee, you go to DEX exchanges, decentralized exchanges, you pay a trading fee, and it goes to trader. But like I said, that's not as important. Let's go to market order. Market order is an order to buy or sell a cryptocurrency at the best available price in the market. You will decide this. That's what they call market order. So if I'm teaching you trading and I'm saying, okay, this is the market order, you already know that is the best price to buy or sell a cryptocurrency. This is how it looks like. When we get to it, you can see here, there is this market here, and then there is the listings, market, limit, stop limit, buy, sell. When we get to the real trading and buying, you will see all of this. Okay. So for now, I'm just letting you know market order is the best price you can buy. So if you go to Pi now, and you say I want to buy Pi, if it is 0.99, that's the best price at that time. That is quoting, that's what you can buy, and that's the market order. Okay, now we have order book. The order book is a record of buying and selling order for a particular crypto. That's your order book. Once you buy, the order book displaying the quantities and price at which traders are willing to buy or sell. And this is how it looks like. I'm sure you would have seen this if you are on Bybit, and then you just see all these when it's very plenty things on the side. Yeah, that's your order book. So the way you are making your orders, if you are buying, if you are selling, everything will be written. When we get to the nitty-gritty, I will tell you all of this, but I just wanted you to be familiar with what order book is and how it looks like. I hope that's fair enough. Next is to take profit. If we say take profit, is an order placed by a trader to automatically sell crypto when its price reach a predetermined level of profit, which is used to secure gains. We call it take profit. You know, most of the time if you are trading, not like you are going to sit on your phone forever. So if you go through the order and you see that, okay, this thing is just to go up, but you know, if I say this thing is going to move from $1 to $3, and then what if it gets to 3.02, maybe $3.02, and then it reverses back? You know, crypto is always like up and down like that. So you can set your take profit on $3 so that once the market gets to $3, it will abort what you add and sell. For example, if you buy, it will stop it and take your profit. So that's it. You have gained, and then it stops. But if you just leave it to keep running itself, of course, that same market could have gone to $6. But what if it returned and goes back to $1? So that's how we use take profit. It is the order placed by trader to automatically sell their crypto when its price reach a definite level or point used to secure gains. So immediately gets there, it will abort your sales, sell what you have, and then take your profit. And then this is the way it is. You see, I call this the stop and loss profit, because you know, if you buy here, you see the buy green button, you buy from this point, and then it goes up. You can set your take profit here, so it will pick the profit and sell the coin and then give you your profit. If you don't, then you can also set what we call stop loss. Stop loss is another place by a trader to automatically sell a crypto once the price is reached, which is designed to limit losses or lock in profit. Because you know, let's say you have $1,000 and a crypto is falling. A crypto coin is falling. If it keeps falling, it can fall to the point that you waste all your money. So most times you are like, okay, if this trade is going down and it has gone down to this level, please stop my loss. Like, don't let it eat my money again. Cut it, and then you can put another buy option there to buy from that point. You know, if something is going down, if it continues to lose, you might lose all your money. But if you cut it and then put another buy option here, if invariably maybe it goes down a little and then recovers back, even when you're not there, it picks your recovery, which is now your buy options, buy order, and then you continue to go up. So that's why it's important you also put stop loss. And if you see it here, you see the stop loss order just to avoid loss. Otherwise, if it goes deeper than this, it can go in and eat all your funds, and then you just get back to your trade and you see nothing in it, or your dollar's gone. So when we get to the real trading, I'll tell us how to do this, but I just wanted us to be familiar with the words. We also have what we call positions. So if somebody is mentioning positions, what do they mean? It refers to the holding or open trades of a trader in a specific cryptocurrency, indicating whether a trader is long or short on a particular asset. Holding or open trades of a trader in a specific cryptocurrency, indicating whether a trader is long or short. Position is just like where you are at the moment. Oh, maybe I've entered the market this way. Whatever I am at that moment is my position. Am I losing? Am I winning? Am I eating? Am I hungry? Depending on the language you want to use, that's the holding position. That's your position in that market. And how you see it is, if you are going long or if you are going short, every time your position will show whether you are growing in gains or you are losing your funds. Every position. It's just simple. Some people I learned on the channel says, I bought my pie when it was 1.90. Now it's on 0.9. So you've lost a whooping $1, which is 100% of what you have. So if your money is not as much, you could have lost everything. You just put $150 somewhere. By the time you get there, you see 000. Everything gone. And that's your position now. That's your position. Long or short, that is the position. All right. We also have spread. The difference between the highest bid and the lowest asking price in the market is what is called spread. And this is it. If you are bidding and somebody is the asking price and the bidding price, the difference between them is spread. These languages are what you use during trading. When we get to that nitty-gritty, you see how it works. But even there are some of these terminologies I almost did not want to put it there, but I know when you are going through this video, you will probably choose the ones that you are comfortable with, the ones that are common. Not all of these words are common, but I just wanted us to know, just for knowing sake. At the end of the day, we have longing. Longing is when you open a position. Remember, position where you are standing at the same time, where you are standing at any given time. When you open a position by buying a crypto with the expectation that the price will rise, traders who go long profit when the price increases. So when you open a position, I want to buy, and then you make that position buy. If you buy from 1.00, that's your position, opening position. You're starting from there. And then longing now is long expectations, like far distance. There are short tradings, there are long tradings. So when you open a position by buying a crypto with the expectation the price will rise and you make it go long, you might enter the position of a market by saying, okay, I want to see what this does in 3 days. Do you know you can place a position, especially with Bitcoin? You can open a position with 1-2 years in mind, just like what most of us are doing with Pi Network, where you say lock my tokens for 3 years. That's a long time thing. You can also do that with Binance. For example, no matter how bad it is, if you start in January, for example, and you put $1,000 on Binance in January was, if I'm correct, was it January or maybe November? Because you have to trace the market. We'll get to it when I'm talking about this. We have the bullish time, you have the bearish time. So you calculate what it is and understand that, okay, if I join when the price is very low, then I'm going to ride it back up. And riding it back up, your $1,000 in 1 year can become $5,000, $4,000, depending on where you are joining the market from. But it has to be long term. Most people want to make money now, which is very risky. The shorter it is, the riskier it is. The longer, the better. So for longing, it is when you open a position and then you go long. Traders who go long, they make more profit. That's longing. Like you make your trade go long. Okay. Now, it is like this. Long trading, you gain. Short trading, you lose. The truth is, when you are doing shorting, when you open a position by selling a cryptocurrency with the expectation that the price will decline and intend to buy it back when the price falls below the point at which you sold it, traders who short profit when the price decreases. Traders who short profit when the price decreases. You see, this longing and shorting is the principle of trading. Because now, even if you have a coin, I told some people in Pi, they didn't believe me. Maybe lack of training, I don't know what it is, but I think it's lack of knowledge. If you have Pi coin that you have and you see that is going up $2.38, what are you expecting for a coin that just listed? That's okay. Maybe it's long throats too. You want to eat everything once because you have pie that has gotten to almost $3. Why have you not sold it? Sell at that point and then keep your money. For example, if I have, let's say, 100 tokens of pie and it goes to 200 and something, 258, that means I now have what now? $258. Sell it at that point, hold on to your $258 and then watch it come back to 0.9 something. Now if you are buying back at 0.9 something, let me do the calculation. You see how easy this will be if you don't really add much emotion to it and you are ready and open to all of these things. Now if I have $258 and now pie had gone back to 0.9, you see that I'm going to now buy 286 pieces of that pie. Now if I buy 286 and then it now goes back to, let's say, $2, maybe in another 1 month, $2, then I will just multiply this by 2, which is now 572. Where did I start from? I had only 100 pieces that I sold at the right time. But you know, some people will not do that short range of selling and then going down to the deep to buy again. You have to continue to follow the market. There is no market in this world. This is how they go. Up and down, up and down. It's just for you to study when it's coming down, study when it's going up, which is why I'm going to teach you all of this. And in some cases, you know, if we have not really got into the whole teaching, because Rome was not built in a day, I already know what's up. I'll give you the signals of when to buy, when to cut, when to continue, and when to abort. So this is how we make profit on crypto, basically, by just following the same rule: shorting, longing. You are doing long time, you are doing short time. Very simple. Okay, next is market cap. I'm sure if you are on the channel, you should know market cap by now. Is the whole total value of a crypto company. The whole total value, everything they own, is calculated by multiplying the current price of the token by the number of available coins in circulation. So it's like shares. Everything you are worth. If you want to know my worth, why is that funny? Like, you want to know my worth? What would it concern you with my worth? But you understand what I mean. If you want to know my worth, you have to calculate everything I have, including probably this microphone, the wristwatch, my face cap, because everything is worth something. I could sell this, sell the laptops, you know, like that. So the calculation of individual circulating tokens of a company and the price, that's what the value is, and that value is what we call the market cap. Now, the market cap of companies are in public domains. For example, for Bitcoin, you can see market cap here is 1.6 trillion. Ooh, you see what I'm saying? 1.6 trillion. And the market cap of Ethereum is 239 billion. You see the difference? Some people don't know that to get to 1 trillion is 1 billion in 1 billion places. That's how it is. And then that's what gets you to a trillion. To get to 1 billion is 1 million in 1 million places. And then you can see Theta is 143 billion. XRP is 138 billion, but Bitcoin is 1.6 trillion. That's their market cap. That's the value of the company, and that's why you can see the reflection of what their prices are. 84,000 is Bitcoin. Ethereum is 1,986. So, and then Theta is 0. It's not even up to $1. You see why I said Pi was trying. Theta is 0.9. Although they have more market cap, they have more value, but Pi is still on 0.92. You see that? Okay. Next is candlestick. Now, this is like one of the major things we study in trading. Is a graphical representation of price movement of a cryptocurrency over a specific period, which shows the opening, the closing, the highs, and the low prices in form of a candle on a chart. And how does it look like? Just like this. You can see here. This one is high, here is close. This is the high point of that time, but this was where it closed. You can see there is a hash looking line that goes up. At that point, the price of the coin got to this high, but when it was to close, it closed there. Depending on what duration you are checking, 1 hour, 4 hours, 5 weeks, you know, it will give you that stripe. And this is what I have on the right. You can see it's giving you what it is per time. We'll get into all these details, but this is what they call the candlestick. So the same thing with if it's going down, the green is profit, the yellow is declining. And if you see this one at the side, it's going up this way, but it came down here. This one went up again, came down like that. So green will represent profit, which is positive. Red will represent you enter bush. You enter bush, that's red. And that's decline and loss. Okay. Now we also have support level, a price level at which buying pressure is expected to outweigh selling pressure, causing the price to stop falling or find support and potential rise is support level. When you get to trading, this support level is very important, because you need to know when is this thing going to go back up. Because if you look at this one now, how do you determine what's going up or what's coming down? Look at this one is coming down. The support level when it's coming down might be here. You can calculate that, and that's how you know it is the price level at which the buying pressure is expected to outweigh the selling pressure. That means people that are buying are better than people that are selling. The price will start going up, and you must get this support level every single time. And you can see it here. This is the explanation of it. Here we have buy here. This is where we buy. It's so dynamic. I'll teach you all of that. It's a variation of things you have to put in play, because when a price is going down, just like Pi Network now is going down, I bought Pi at 0.9 cents, and I usually buy small $50 0.9. If it goes to 0.8, I buy another 50. 0.6, I buy another 50. Like that, I just continue like that. And if it continues to go up, I'll leave it, and my expectation is for it to get to $2.50. So depending on where it starts from. Now if I buy one at 0.6, if it gets to $2, I take profit. Do you understand my variations? If I buy at 0.9, I'll wait for that 0.9 to go back to 2.5 before I take profit. So that's just how I do it randomly. So it depends on how fast it gets there, and if I'm tired of it, I can abort, but most of the time I usually get to the end before I leave. But you need to know where your support level is, so you know where to buy. Once you know that, oh, people are no longer selling, there are varieties of things we look at into. I'll teach you all of that, and then you start buying from there. Okay, we still have the resistance level as well, where the selling pressure is expected to outweigh the buying pressure, causing the price to stop rising or face resistance and potentially fall. You know, if you are profiting and things are going up, some people will say, it's still going up. That was a mistake some people make about Pi too. It's still going up. They can't recognize that it had reached its resistance level. It can't go up again. It has to start falling. It's like somebody asking you to go and carry a car. Just imagine, it says, okay, the car is bad, and then the mechanic is not here yet. Let's go and take the car to the mechanic. The battery is not working. Oh yeah, carry it. Can you carry a car? You might attempt to lift it, but your resistance, you don't have capacity to carry it. If it's a jerry can, of course, your ability can carry that, so there's no need for resistance. But once the market becomes so pressurizing, it can't go up again, it will start falling. And that's why this is also important. Look at it here. This is price got rejected down from here initially. So this price here, this is where you quickly sell and take profit. So once it's coming to your support level, down, that's where you now buy, so that you can ride on the wave going up again. This is the basic resistance and support level. If you know that alone, boom, you are into money making, and you make a lot of money from crypto. As simple as that. But also we have derivatives. Derivatives, the financial instruments that derive their value from an underlying crypto asset or benchmark, allowing traders to speculate on price movement of cryptocurrencies without owning the underlying asset. This one has different types. We have the swaps, the forwards, perpetuals, the options, the futures. But all of these, nothing concerns you with this, I must confess. This is not your headache, because yours is to trade and just move on. Like I told us, I just wanted us to know all the types. Swaps is an agreement between two parties to exchange cash flow between one another. Of course, forward is an over-the-counter contract between buyers and sellers to agree to trade their assets at a pre-decided price on a future date. Now, we are not in class, so not like you want to write exams with this. You don't really need this at any point, because if you want to trade whatever form of trading, whether sport or whatever you want to do, up go, you go. You don't need to know what goes on in the blockchain or what they are signing. You only just click, boom, you are there. There is usually no mistakes between these things. So that's derivative. Let's go to arbitrage. This one too, I've tried it before, but I don't really like it because it's very dangerous. The practice of taking advantage of price difference in different markets and exchanges to make a risk-free profit. If you see this, let's say there is a coin that is listed on BitGet for $2, and all of a sudden you see it on $1 on Binance. What do you think will happen? You know, there are different exchanges. Immediately you don't chop with that, because now all you need to do is buy from here, sell on here, and it's the same coin. You don't need to wait till tomorrow. Buy $100 here, you take it here, it becomes $200, because it's $1 here, it's $2 here. Arbitrage. selling the same thing here for here. Just like our market women do. If you've seen these market women, the farmer will come from the farm, says, let me buy your banana, 100 naira. Immediately the banana person sells. Sometimes they have not even paid. They just say, have you agreed? 100 naira. They carry it this way in the market. They put it down like this. Somebody else, the customer is coming. They say 200 naira. You pay them 200. They give the farmer 100 naira. Right there in your front. They do it for chickens, do it for virtually everything. And that's how. Even for computer centers. You want to buy a phone? Come to my shop. They are not the owner of the shop. They just take you the arbitrage. So you can also do that. If you are studying two different exchanges, you can see that there are discrepancies. Maybe something is 1.05 here, is 1.0 here. That's 5 cents on every coin. But like I said, by the time you buy it here and you want to go and transfer and resell here, before you get back here, prices might have changed. So that's why I said it's a little bit dicey, but it's risk-free. Anyway, that's what I did here. You can buy from one exchange and sell to the second exchange and you make profit. So buy from exchange 1, maybe Binance, sell to exchange 2, where it's more competitive and expensive, and then you make your profit. That's arbitrage. Okay, we have DeFi. DeFi is an umbrella term for peer-to-peer financial service on public blockchains, primarily Ethereum. Now, this DeFi is a short word for decentralized finance. Now, DeFi is another word that you don't really have to stress yourself with. It's not going to be common in usage, but it's an umbrella term for peer-to-peer financial service on public blockchain and primarily Ethereum. We have them. You see, each one of them. Now, these DeFi coins are like, let me explain it this way. They are like, if you have a wallet, for example, if you have a wallet with, let's say, Ton wallet, it's Ton that controls that Ton wallet. We say cryptocurrency are not controlled by government, but Ton controls its own wallet. You see, Binance controls its own Binance wallet. Whatever wallet you use, Tonkeeper controls their Tonkeeper wallet. Okay, but now these big juggernauts, they have created some wallets that doesn't have control. They don't even have control over it. Like, they can't see what is inside. They can't access it. As I am, GTB can access my GTB account even when I'm not there and I did not give them their password, the password to it. They can still get inside and know what is in my account. But with what they've done with Ethereum, look at the companies that have done it. Ethereum is the biggest. It has about 606 DeFi protocols that allows people to have wallets that nobody have access to. Nobody. Even if FBI catch you, nobody can have access to it. I'm just saying. You see that? So that's DeFi. It's a decentralized finance, and there are so many companies that have it. Solana, Avalanche, Kronos, Harmony, Echo, BNB Chain, all of them, Polygon. They have all these DeFi. It's like a product, a wallet product that they give to clients. If you don't want anybody to know anything about it, of course, that's also good. But like I said, it means nothing really changes anything. Maybe these people know what they'd use it for, but for me, it's nothing really. Okay, yield. The return on an investment, we know, just like your yield, if you plant yam and it yields very fine, is the return on investment expressed as percentages of initial investment or the current market value. Then we have yield farming, a practice in DeFi where users provide liquidity to decentralized exchanges or lending platform and earn rewards or interest in form of additional tokens. It's like you are running a loan company. Put money there as borrow, and then they pay you profit from it. Practice in DeFi where users provide liquidity to decentralized exchanges or lending platforms and earn rewards or interest in the form of additional tokens. Okay, that's just fair enough. Then we have leverage. Using borrowed funds to increase the potential return of an investment, allowing traders to control larger positions with a smaller amount of capital. Now, this is doable. Okay, let me cite an example. Even Binance, BitGet, they have all of these. You want to use $10 to trade, they can allow you use $50 to trade. Even when your original money is $10, they will tell you to use $50. And then your profits, whatever, if you gain, then you can start paying that back. They have a way of doing it. And if in case you lose, you can also lose, and then you now lose the monies that you have. You understand it? So not like they'll put minus, but that's the way they do it. I usually don't do the lending thing, but probably because I want to teach you now, I have to do it so that I will know the whole progress. That's what they call leverage. When you don't even have that fund, you can leverage based on the platforms that offers it. So you can have $10 and then put in something of $50, and they allow you use it. Okay. Now we have technical analysis, a trading analysis method that involves studying the historical price and volume data of crypto to forecast future price movement. Technical analysis is one thing I'll teach in the class, and I'm saying a whole module. There are different types of analysis that can go on to let you know if a price is going up and down. I told you this trading thing is like Bet Niger. It's just like you are saying Arsenal will beat Real Madrid home and away. How many times have they met head to head? That's technical analysis. You study what the coins are doing, especially these trading pairs, USDT versus this. What are they doing? Euro and this, buy and this. So you just go through it like that. Different methods. Although I don't really spend much time on this, because at the end of the day, I have so beliefs. When I teach you these things, sometimes it's follow your instinct. You see, sometimes follow what you've heard in the news. I read more of news. I do more of journalism than reading technical analysis, because you might not know that something has happened in India, for example, that had impacted something, and then of course the price of things will go down. It's just like when there was in Nigeria, if you are trading in naira and then they say there is a end SARS protest and nobody's going out, or there is election, of course that day there won't be anything, the price will go down. It's just simple. But if you don't know and you are reading historic whatever, if you miss that, you are going to trade wrongly. So but technical analysis, fantastic. We'll get to it as we go on. Then we still have fundamental analysis, a trading analysis method that involves evaluating a crypto intrinsic value by analyzing economic and financial factors that might influence the price of the token. This one is like you're listening to bank CEOs, you are listening to word like Elon Musk. Sometimes if Elon Musk say a word, it will determine where a crypto something is going. So the financial and economic analysis of a particular coin can determine where the price is going. So that's fundamental analysis. Like I told you, technical analysis, you can study the price, historical price and volume data of the crypto to forecast where it's going. Same as fundamental is the analysis of economic and financial factors. So you see, there are lots of things to study before you can come up with what you should do on a particular trade. Now we have bull market, a market characterized by rising prices and optimism among traders. Bull market is when everybody is saying, oh, this thing is going up. When the prices are up, that's bull. When the prices are down, bear. That's bear market. So once you see somebody say, I'm going to buy blah 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 bear market, it means I'm waiting for that price to come down. Just like I predicted that pi is still coming to 0 point, and I'm like, I'm not going to buy at 1 point until it gets to 0 point. That's bear market. I assume it's coming down. I know it's bear market, and then it's going to come down. So these are languages they use. Bull market when it's going up, bear market when it's coming down. And then this is hold on for dear life. Before I joined crypto, each time I see somebody says HODL, I think they always make a typographical error. It's a misspelling of hold, often used in crypto communities to encourage people to hold their crypto as a long-term investment strategy. Those days I thought it was misspelled. I usually put my own HOLD, like old, but it's a misspelling of old. It's a signal to tell you that do not sell your crypto, hold on to it, and then it will go up or it will become more valuable. Also, this is a word that you can also keep up with. Then we still have FUD, food, which is fear, uncertainty, and doubt. It's a term used to describe negative information or rumors spread in the cryptocurrency community to create fear and uncertainty potential, leading to decrease in price. Those exchanges, I know of this because I made a video about it today. Well, I said Pi community, they are afraid that the exchanges are making food about them. This is like they are creating uncertainty. They are saying, no, we don't know where this thing is going. And once people cannot really stand behind the coin, they start selling. And once they are selling, the price starts dipping and going down. So sometimes a strategy that some influencers might use to derail, investors and customers that are involved so that they can sell and then the coin becomes trash. They call it food. So when you hear FUD, food, you know that it's fear, uncertainty, and doubt. All right, these are the crypto words I want us to learn today. I hope you have seen the ones that are really attractive and the ones we are going to be using. Please take notes of these so that once the training really starts, and then we are going to details of these. Once I use some of these words, I'll try my best to explain again, even if I'm teaching those words. But let's start reading these words and getting conversant with them so that it won't be strange once we go into the nitty-gritty. All right, I'll see you in the next class. Have a great day.